economy and the macro backdrop. And this is what I'm talking about, by the way, when I'm thinking about the secular and the business and then the tactical cycle. So the secular, we're talking about decades of time, at least one. And if you just think about what we've been kind of seeing, we were in a very, very staunch bull market coming out of 2009. And we had more or less been in that phase. I know we saw that dramatic drop during COVID. We saw a pretty decent decline there in 2022. However, in both instances, we rallied relatively quickly. I mean, think about 2020. We went down all that way, but we finished the year higher. 2022 wasn't quite the same. We were just kind of tactically selling off from the very beginning of the year until October 13th was the bottom. And then we got a decent rally to close out the year. We started to overcome some different price levels at the beginning of 2023. Then we ran into the regional banking crisis in March of 2023. So that kind of put a dent in the rally attempt. But then we rallied throughout the majority of 2023. And basically coming into this year, we were set to start exploring above those all-time highs of 4,800 on the S&P 500. And we've done that a bunch of times this year, even though obviously we've run into a little bit of a hiccup here just this week. But this is really what we're thinking about from a secular business cycle and then what they term tactical point of view, which is the secular is that long term, or being a bull or a bear market. You could think of a bear market being from 2000 to roughly 2009. If you think about what was going on there, somewhat of a lost decade, right? And maybe it's probably easier if I'm given visual clues here. So let me go to my blank chart and step this back just a bit. When we think about what happened in 2000, why we call it a lost decade is because we hit those highs right at the beginning of 2000. Let me zoom in on this here just for a second. We hit these highs right over here, and we got up to 1553 on the S&P 500, and we pretty much retouched them again right before the global financial crisis and went slightly above. We peaked ahead in October of 2007, and then we get this dramatic decline again. And we didn't actually overcome that until 2013, and right there in June of 2013. And the beauty of it is if you were able to stay the course during that time and you had a long enough time frame for investment, you were greatly rewarded in the following bull market. And that's clearly what we can see here. And I know this is sideways, less down, but you have two pretty substantial down periods. And if you think about what's going on from an inflationary standpoint, real gains there are obviously not intact. And even notionally speaking, if you were in that 2000 and you bought the top there, it's dead money for effectively 14, 13 years. So pretty long time for you to sit there and not actually see any appreciation on your assets if you were invested in the whole, right? Obviously, there were some investments that were not doing this exact picture. They got out from those peaks a lot earlier. Some, didn't run into those peaks there. I'm talking about strictly from a broad market perspective. But let's hop back over into fidelity.com. So that's the first thing that we're thinking about. Second thing we're thinking about is the business cycle. Business cycle being the concept of that expansionary when the economy is reopening, maybe reflation is going back on. We haven't thought about that term in quite some time. It's been the opposite. We were thinking about inflation. Reflation is where maybe we had a bit of disinflation or potentially even deflation in assets and prices are reinflating. That's what the concept is. And there's certain sectors that tend to outperform during those timeframes. As we grow out of that and we move into more of a mid phase where maybe it's slightly slower growth, but it's still growing at a pretty healthy rate. And there's certainly things that are doing better during that time, things that are doing worse. Then there's this concept of late, where maybe inflation is starting to creep back into the picture, and it's maybe forecasting for a recession. And the severity and the depth of recessions, we haven't really seen a significant one in terms of time frame. If you're not aware, 2020 technically was a recession defined by NBER. It was only 2 months. It was basically a quarter effectively. So it's kind of hard for us to imagine for a lot of people that haven't been investing for more than a decade, what it's like to be an investor during a period of recession where it's lasting for more than a quarter and the economy instantly rebounds. It's not really a thing that a lot of people that are newer to investing have seen, but it is something that could potentially happen. And I think that's mainly what you've been seeing in the last week kind of play out. We went from this really rosy scenario where even the concept of a soft landing wasn't really being discussed. It was more of we're skipping the landing, we're going back to mid phase. We're actually returning to an expansionary phase of the economy. And now there's the idea that hey, jobless claims are starting to go up. The credit is getting pretty tight. Inflation has come down, but maybe that's going to actually flip and go the other way, where maybe we're potentially going to even see deflation. Again, these are, I don't want to say predictions on our behalf. These are just narratives that people are starting to assign a probability. Institutions are starting to assign a greater probability of these events being possible. And that's what you're basically seeing in terms of the price reset that we saw earlier in the week. So we have that concept. And then within the business cycle, of course, we have the tactical, which is usually we're looking 1 to 12 months out. And we're thinking on a much shorter term basis when we're thinking about those concepts. But that's the general idea from the top down, right? We want to think about where are we and where do you think we are in terms of the secular cycle. And then from there, we can go into the business cycle aspect and maybe even be a little bit more specific and come up with allocation percentages or aggressiveness depending on the tactical point of view. And then once we get that kind of settled in, I flipped over to sectors, but I'm just going to stay here for a second before I talk about the business cycle more specifically and the update. And the reason why is because once we have a concept of what the business cycle does, we might be looking at sectors, industries, maybe even specific investments within those sectors or industries. And we want to know, well, what's positioned well and what is historically done good during these times. And that's where the investment research update is going to come in handy. Again, provided by Denise Chisholm, and she's just going in here, and I'll just pick a random page here, right? And this is kind of one of the concepts of what you might see in a report like this, where she's talking about mid caps and small caps having a similar setup, relatively low valuations, giving an idea or a concept for that. So thinking about the relative forward EPS yield for the S&P 400 versus the 500. 400 is just we're looking at the mid caps there. That's a different way of looking at the index. There's also the small cap. I believe they put 600 on that, so it's 1,500 stocks in that universe from Standard & Poor's. And then just looking at those low valuations on the right-hand side compared with large caps that have signaled mid-cap outperformance. So she's just looking at NTM, relative performance, that just stands for next 12 months, and then looking at relative valuation quartiles and deciles. So basically breaking them into buckets of 10% increments, and then also looking at those quartile valuations as well. So effectively, a lot of stuff like this. It's pretty data intensive. That's what she is, right? She's a quantitative analyst. So a lot of her research is based on, well, okay, let's try our best to identify where we think we are. Go and look at similar times in the past that this scenario where we think we are have occurred, and we can be a lot more definitive about that when looking from the hindsight perspective. And then we're trying to make our best determination of what is positioned well or what can potentially outperform based on where we think we're at and based on historically what has occurred. That's the whole concept of what she's trying to do with this quantitative analysis. And she does that, I'm looking at mid caps, but we pick another one here. She's talking about the tech sector and doing a similar type of analysis with this, obviously looking at slightly different information, but looking at those earnings forecasts, you can see them bottoming out in late 2023. So the earnings recession, even though the economic and the earnings recession, those are two different things. Looking at the economy, typically when earnings have bottomed, that's a good sign that maybe the worst is in, and effectively that's what we saw in 2023. The problem was we were expecting it more over here, and I think the expectations were a little bit worse than what they ended up being. And we never really saw a full-on recession materialize. So just looking at a number of those different things. And then the other point I wanted to make here briefly, and then Troy, I'll turn it over to you. The other point I wanted to make was when we were showing this, right, we were showing what's been leading for the last month and then what's been leading for the last year. And there's a big divergence in the last month versus the last year. And I highlighted it yesterday, and I just wanted to clarify the point. We have communication services and tech that have been, pretty much neck and neck, but clearly head and shoulders above everything else from a sector perspective. And when you think about, well, when does that usually do well? Well, it's when we're in the more mid phase of the economic cycle or the business cycle. What tends to do well in the late and the recessionary? Well, we have two things in common. Utilities and staples tend to do well in both. Energy is specifically towards the late, because that's usually when inflation is popping up. Things like the price of oil, the price of energy start to increase. But when we go into full on recession, or that's where we're about to head, then typically those things get depressed because the demand for oil and the demand for energy goes down substantially. Similar in real estate, tends to outperform well in late. Think about housing prices, rent prices. It's been a big deal for the last couple of years. It hasn't completely gone away, even though the market's a little bit gridlocked right now in terms of housing. People don't want to sell. A lot of people feel priced out. So we're seeing a stagnating market there. But, and you can see down at the bottom here, for the last year, real estate has started to rebound. If we could have looked at a snapshot of this a year ago, it was not an overly good performing sector, right? But and that's maybe highlighted by the fact that if we go to a 5-year, you can see the real estate has been at the bottom end if we're looking at a annualized 5-year performance here. That being said, or that's not even annualized, that's a total performance. So it's even worse. And then what we're thinking about from the 1 month perspective. So what has kind of happened in the last month? Probably a lot of you have heard on the TV about the concept of rotation. I tried to clarify what that means because I hate the term, frankly. It can mean different things to different people. For me, I define that as it doesn't mean that everybody's hitting the exit for this to go into this. I mean, some of that might be occurring, but it's more so the idea of maybe sectors that haven't got as much attention are starting to gain some attention, gain some allocation, and think about what's happening right now. For the last month, it's been real estate, utilities, consumer staples, and healthcare. Let's just think about those four for a second. Where do they fall in on this chart? Well, consumer staples, late to recessionary. Healthcare tends to outperform in recessionary. Utilities, late recessionary. The only one that's, kind of sticking out is real estate, which is late and tends to not do well in the recessionary phase, which is, again, kind of interesting. And then even the ones right behind it, I know it's amazing because this has even fell off a little bit from yesterday. But industrials, financials, materials, that's actually more in the early phase usually, right? Industrials, materials, real estate tends to do well, financials tends to do well in that time frame. But the things that are really dragging behind are going to be the communication services, information technology. And then, of course, we have the consumer discretionary, but you can see that's been beat up before even the last month, right? Year to date, it's down 3.75%. So it's kind of the laggard on the year, regardless of what's happened in the last month. All right. Troy, with that being said, wanted to give you a chance to jump in here. I'll take a look at some of the questions that were coming through and just wanted to gather some thoughts from you.
Yeah, absolutely. Matt, there's tons of useful information on these research pages on Fidelity.com. So just in case anybody missed it once, if you missed it twice, where we're going is we're going to this news and research tab. And if you type in stocks, if you click ETFs, if you click markets and sectors, it's going to bring you to the same page in one of these sub tabs. Markets and sectors will bring you here, or actually it might bring you here, and then you have to click markets. If you click ETFs, it'll bring you to this tab. If you click stocks, it'll bring you to this tab. Notice that even if we click to different tabs here, these little icons will stay the same. So there's some shortcuts to some research reports, there's a shortcut to the screener tools. Let me go ahead, just make sure everybody can see that. So you can have some shortcuts to the stock screener tool that was talked about in the webinar. If you're interested exclusively in ETFs, there's an ETF screener tool. There is also a mutual fund screener tool that's not shown here. There's a separate spot for that, but there's a number of other different fund type of screeners. You'll see as of yesterday's close, the market's actually doing a little bit of a rally today. S&P is up a little over 9% as an index. So, that can kind of be a gauge to say how are we doing so far this year? And you can see the relative year-to-date performance of different sectors. And like you pointed out, Matt, this is not a recommendation at all. Just because one sector has done good doesn't mean necessarily it has to do bad the rest of the year. Just because one does bad doesn't mean it has to necessarily catch up. One that's done well can continue to do well. One that's bad can continue to do bad. But there can be that rotation. There could be the one that outperforms and now it underperforms later the year. There could be a sector that underperforms and starts to play catch up. The business cycle is very, very heavily talked about. If any of you out there watch your CNBCs, your Bloombergs, or Fox Business or Yahoo Finance, whatever you watch, this is a huge topic, and it's more of a conceptual idea as opposed to a definitive mechanical definition of the economy. There can be times where, hey, usually macro data is lagging, right? Life happens, and then next month we see the reports that characterize last month in terms of jobs, inflation, all the things that happened. And so economists get together, and Fidelity does this in a great way, where they say, all right, based on data, based on a variety of different factors, there's usually a pretty decent consensus about, are we in an expansionary or a contractionary cycle of the business cycle? And it does we go from late and then we jump right back to the beginning and go back to early stage. Sometimes that can happen too. And sometimes we think we're in early stage and then something happens like COVID, like some unexpected event, and maybe this pushes us into a technical recession. So again, this is more of a qualitative aspect, but it is developed based on quantitative data there. So it's meant to be helpful, right? Because if all economists are saying, hey, we are in a late cycle and we're about to enter a recession, if that happens and if that's your outlook as well, then might you say, okay, I have a very heavy exposure to, for example, consumer discretionary. Well, if you're invested in companies that have discretionary products, the latest handbag or the nicest pair of sneakers, well, if we go in a recession and people start tightening their budgets, maybe they're not going to go out and buy that latest handbag or pair of sneakers. So maybe those type of companies could be more adversely affected than, for example, other companies where they have more staple type of products. You can see that consumer staples tends to do well late cycle and into a recession. But again, no PE, your price to book, your price to sales. I'm looking for companies that maybe have certain growth metrics. From a fundamental perspective, there's no one way to do this. A lot of times, fundamental investors, there's certain techniques. There might be more value-oriented investing. There might be more growth-oriented investing. There might be blended approaches that use a mix of the two. So again, there's no kind of one size fits all here. I think having some of that macro data can kind of help you visualize or understand, all right, what kind of companies do I want to look for here? Do I want to be more defensive? Do I think that the economy is about to go into recession? Do I think we're actually not going to go in recession and these fears are overblown? A couple of you had some questions about that, thinking, hey, we sold off really quick and fast. Is the economy really that bad? And maybe there's some other things that kind of led to the sell-off. And again, it depends on who you ask. There's smart people who can make good arguments on either side, but you have to make horse with legs. I'd be interested to see what criteria it uses. But if you click on any of these, it's going to, again, give you a list of companies, and it's going to give you a description of here's what we're looking for, and here's are some risk factors. Anytime you're making any type of investment, there's always going to be risks, right? That's why we call it investing. We don't call it free money. We call it investing because it has risks. So what are some of the risk factors for investing in value stocks or stocks we think are trading at an attractive value? The risk is that they could actually be fairly valued, and they could be cheap for a reason, and they could continue to get cheaper. So again, that's the risk factors, and it's up to us to have some kind of a plan.
Than the S&P 500? And the answer is no. And let me show you why. So let me hop over to Fidelity.com and show a couple of things here. So the way to get to this screen, if we're just on, and I'm using Lockheed, I'm using a different symbol, but if we're on the main research page, we go to analyst ratings. What we have to do is underneath the research reports right over here, if we scroll down, you'll see explore all research firms, and then you'll see research firm scorecards. If you click on this, so if I click page as well, you can get this understanding and using the equity summary scorecard. If we go over there, it'll give us this methodology, and it'll break it down how it actually is doing it. So effectively what it's looking at, there's a universe of stocks, and then what they do is they go and look at what the firm or the sector ratings accuracy has been for each of these firms. So if you've been better in the last 2 years at predicting a certain sector than a different company, you're going to get a higher rating, is effectively what it's doing. And then it goes in there, and what it's actually doing here is for the 1,500 largest stocks by market cap, they're forcibly ranked against all the other scores to create a standardized equity score from 0.1 to 10 for the 1,500 stocks. So what does that mean, forcibly ranked? Well, it means that they're trying to basically get a certain amount of companies in each of these buckets. That's why it's you're trying to evaluate the largest stocks, meaning that effectively we're going to have some stocks in each of these buckets, even if the market is in a straight down plunge. So very important to understand that concept first and foremost. But then when we go over here and we look at, well, what is this actually trying to tell us when we're looking at total return by sentiment? So it's giving us our buckets, and it's comparing it to two things. So it's comparing it to the orange line, which is all the stocks, and then it's also comparing it to the S&P 500 total return. So we're eliminating basically the 501 through 1500th largest market cap stock. Is just looking at the top 500, and it's not 100% precise because there's some that are bigger that aren't in the S&P because they have other qualifications and standards that determine how they incorporate what's in their index. One thing that the scenario. So what is the point I'm making here? If you just go out and you're blanketly using a number on a screen from an equity summary score to make the buy decisions in your portfolio, it's probably a mistake. You're probably going to underperform just something basic like the S&P 500. I mean, not guaranteed. There are probably moments in time where these things do in fact outperform, but it's not something I would personally do. So how do we use it? And they give you a piece of advice here, right over here. So you can use the equity summary score in many different ways. One of the ways is to screen criteria to identify stocks to include, or I think the second word is more important here, or exclude from further analysis in conjunction with your other screening. You can also use it to monitor the quality of opinion, fidelity. And you search, you can get some on it's usually a daily report talking about commodities. There's a couple on currencies, and then some of the overall things that are going on in the market. But I'm gonna have to say take that with a grain of salt because they could have pulled this and not let us know. I haven't actually looked at this in a couple weeks, so I'm hoping that's not the case. Couple of other things that I wanted to hit here. So we had some questions on charting. We didn't talk about charting hardly at all yesterday, but if we go back to the main research page, if we go over to our chart plus, we can chart a lot of these symbols. And this is more the technical analysis side of things. And I saw some questions a little earlier about identifying stocks that are, reversing intraday, or there's a situation where we started high and moved lower. I mean, there's not a whole lot that fundamentals is going to educate you on uh, about a short-term price traction. I mean, maybe you can get a sense from the macro view, or maybe if you're seeing a change in sentiment from a report or something like that. Yes, those are things that can potentially change uh, price action time, because nobody can actually trade the VIX. So it's not like somebody went out there and actually paid 65.73 for the value of VIX, thinking that it was going to continue to go up and we were going to see a profit in the future. Nobody was doing that. You can trade the VIX futures, and you can't do that through us, but you can trade VIX futures, and that's a better gauge of what the actual volatility was at the time for the next expiration. And spot VIX and the VIX future are different things. So I want to just mention that for a second, because a lot's been made over that number. It's usually by people that had no into the calculation and what's actually occurring that we can see. Let me just shrink this a little bit so everybody can see what we're working with here. So if we go over, first of all, there's just this glossary in general, and then here's the economic calendar that I was referring to. But let's just go to the stock screener for a second, because there's a lot of terms and some of them may be obvious, some of them may not be as obvious. If you go over, especially when we're getting into things like, company value, PEG ratio. So if you're looking at something like this, what you should see underneath each of these, once you actually click it, and it's trying to give you the options, of what PEG values or PEG ratios we're looking for. And what you'll actually get is a definition for. So all we're doing here is we're taking a stock's forward PE. So again, and to understand what they're talking about in the sentence, and then you click on that, and before you know it, it's midnight, and you've spent 2 hours of your night on Wikipedia in a wormhole. Forward PE is just looking at what is the company going expected to make for the next year in terms of its EPS. So that's its earnings per share. That's what is being reflected right here. So looking into the future, what is it projected to make earnings per share, and then you basically divide that by its price, and that's what gives us our forward price to earnings ratio. And then what we're doing here is we're dividing that by the projected 3 to 5 year annual earnings per share growth rate, and that's giving us our PEG ratio. And generally speaking, we're looking at PEG ratios, and it even defines this for you. The higher the PEG ratio, the pricier the stock is. Why is that? Because, well, right now it's priced a certain way. So if the price is, think about it this way: if the price is 1,000 and the earnings per share are, let's say 100, that would give us a PE of 10. Well, what if earnings per share were 10? Well, now it's going to be a lot higher, right? Now our PE ratio is 100. So basically that by itself is telling us that it's priced very, very high compared to the earnings that it's currently projected to make, right? However, if we're looking at, well, what are the forward PE ratios, but not only that, but not just for next year, well, what is it supposed to be making earnings per share growth rate over the next year, and how does that compound? Well, if they're having a high compounding earnings per share growth, what what's eventually going to happen is for a PE, that divisor, so that the part that's on the bottom of the fraction, that's going to go higher and more and more and more, and the growth rate is just also insanely high. So when we're comparing the PE to the growth rate of the earnings, it started to make a lot more sense. And sure enough, the stock went from being worth about $100 to, or not 100, but $300 to 1,300, almost 1,400 at its peak, and that's pre the split. I'm thinking about it in pre-split terms. But the point of this, if you're ever confused or not sure because you've never seen a term, you can get that definition and it'll break it down for you. Troy, I saw a lot of questions come in. I want to give you a chance to jump back in here. We've got about 10 minutes left. Anything that was catching your eye?
Yeah, again, there's so much to go over, Matt. So again, I think a good overview is, and a lot of great questions, and in honest and in full earnest, there's questions like, hey, what type of criteria should I look for? What's the best way to find the best stocks? And again, there's a stylistic element to this. If it was a one type of approach, everybody would use that approach, and that's not exactly how it works. And it's not us being, difficult or being opinion. It's just the honest truth is that in different environments, different styles reallocate a few different ETFs and funds, and that's perfectly fine. And they tend to be less active. There are other clients that are more trading, inclined, where they're going to look more at trends, they're going to look more at charting, and then they're going to say, okay, I like to trade technically stocks based on certain patterns, but maybe I want to have companies that have low debt. I want to have companies that are not too high valuation, so we don't have sudden, valuation adjustments. So you could use the screener and say, hey, here's a list of 50 companies or 20 stocks, and of that maybe 5 of them are giving you a good signal. So of that 5, maybe you want to research those a little bit more, pull up a chart, do something, and maybe you nibble on those 5 different charts. Again, that's just kind of one thought or a perspective there, but again, a lot of what we coach to as a team is to make sure, regardless of how you find opportunity, you also have to play defense, right? So you got to be careful, especially with single stocks, because we know stocks are companies, right? Companies as a whole make money, have earnings, cash flow, they reinvest and try to make more earnings, more cash flow. And so when you invest in something like an index, you have kind of a built-in level of safety because it's really hard for a whole index to go belly up. Whereas occasionally there are single stocks that do go belly up. And, depending on what universe you're looking at, it can be a little bit more prolific than. So all approach with caution. Always have kind of a screener tool. You can use a lot of different criteria. Once you click into a company, there's a lot of different information you can click into, the analyst info. You can go into key statistics to better understand more complex valuations. And just keep in mind, again, from a fundamental perspective, there's a couple different aspects. There's understand company, right? What sector is it in? What industry is it in? What does the company do? And then think about things like, does the company have a lot of debt? Does it not have a lot of debt? Is the company trading at a relatively high valuation? Is the whole industry like that? Is the whole sector like that? If it's trading at a premium to the industry, maybe there's a reason. If it's trading at a discount, what's the reason for that? And is the company been growing well? Is it going to continue to grow well? A lot of times, successful fundamental investors will look for things like valuation expansion, or they'll look for good performance. Sometimes you can have a stock that has really good performance, but it can have a valuation compression. So if a stock goes from a 50 PE to a 45 PE, you might think, oh, it doesn't sound like a big deal, but that's actually a 10% shave just by a 5 PE point change. And you can do that with real quick and easy math. All you have to do is just divide by 50 and then multiply by 45 to get your new multiplier. So, just think about things like that. On fidelity.com. We want to equip you and give you all the tools possible. And by the way, if you're out there thinking again, there's lots of tools, and at the end of the day, you're going to become more comfortable with these tools as the more you use them. So definitely take some time and fiddle around with some of these tools. The last thing, Matt, I got a couple questions about, hey, how do you get that Active Trader Pro thing? On the Accounts and Trade tab, there's a link to Active Trader Pro. There's also, you can go to fidelity.com/ATP. And you can learn more. It's free to download. You have to have a Fidelity trading account. It's the same login. We do host a recurring monthly class on using the Active Trader Pro platform. So if you haven't already, go to News and Research, go down to where it says Learn. And on the left-hand side here, under where it says Events, there's lots of other daily events that we host to help clients with tool demo, with technical analysis, using Active Trader Pro, a lot of these things. So again, at the end of the day, make sure you get the most value out of your experience here at Fidelity. I know we're close to time, Matt. Any last minute thoughts, questions you want to
Yeah, let me
address?
hit a couple of these questions because getting a lot of stuff about ETFs. So let me just steal the screen from you and kind of talk to some of these points just briefly, and that'll be enough here, I think, to close us out of the session. So when I'm looking at, my apologies, let me get the right thing pulled up here. There we go. All right. So when we're thinking about ETFs, first of all, we can just type in any of the ETFs that we're looking for. There's an ETF screener, just like we have one for the stock screener as well. One of the first questions that I was saying is, well, okay, if we're looking at an ETF, first of all, what we want to try to determine, because it used to be that the whole point of an ETF was that it was passively managed, meaning that they weren't really attempting to beat the index. They were just trying to effectively pick an index and then follow it. And a lot of them still do that. But there's now this new concept of um, actively managed, or they're trying to go out there and seeing the few questions on minimum about ETFs, and even ones like this. Well, we give us how is it performing. So we have this right here versus the Russell 1000 Value Trust, which is just an index, and you can see based on the index versus how this is holding, it's slightly underperforming, but that's also not shocking because what does an index have, or not have, I should say, that the fund is going to have? And that's an expense ratio. And then there's also slippage, meaning that the index, it just picks what's in there and it holds it. And maybe it does some kind of rebalance on a quarterly or annualized basis. But with an ETF, you're looking at a situation where people are putting money in, taking money out, and you have to do trades to make sure that it's balanced. So there's naturally going to be some slippage from, or what the technical term is tracking error, that's going to make it deviate sometimes from what the index is doing. But the actual goal for them is not to outperform this. They're literally just trying to do whatever that index is doing. They want to do the same thing. If the index is down 10%, they want to be down 10%. Not because they want you to lose money, but because the goal of their product is to give you the exposure to the index that they're trying to say that they're exposed to. Now, if you want to know exactly what it's doing, and this one is doing just that, right? It's trying to track the Dow Jones U.S. Dividend 100 Index. So that's how they're deciding what goes into this fund. Whatever this is holding, or whatever that index is reporting as what's in there, that's what they're going to match. And if you ever wanted this momentum funds, if you the best way to do it, you got to just click on the prospectus, and what this will do for you, it's going to be linked, but it will give you and find out, well, what are the investment objectives and risk of this fund. So let's say this one's a little maybe less clear. What does a U.S. broad market ETF do? So it tells you exactly what their objective is for this. It says, what it's trying to do. And then if you keep going down here, it'll, if we go a little bit further, give you some more of the risk. It'll tell you those same things for each of those funds. So that's the best way to get that information, is to go in there and just read through the prospectus, and usually they'll outline for you what exactly it's trying to do. Let me talk about these momentum funds for a second, because we had a question on, let's do, and I'm not overly familiar with these, but I get the general class of ETF that these are. So yeah, this is the Invesco S&P Small Cap Momentum Fund. And what you can do is come over here to comparisons. And I think you gave me one that's slightly different, but you can see they have the Spider, iShares has one, Invesco, Vanguard, and some of these might not be all momentum based ones. Pure growth. And what you can actually end up doing, let's just throw in one of the ones that you gave me here. So you have SPSM, and you can actually come down here and you can compare apples to apples between the two different funds, and you can go through a number of different screens. So is this one, you can go to equity fundamentals. You can look at, what are these things trading from price to book perspective through all of these different categories. So I saw some questions about, how do we compare different mutual funds and ETFs? How do we do some research on those? Well, this is effectively it. You read the prospectus, you understand what is their objective and what kind of mutual funds or ETFs am I looking for. If you're doing something that's actively managed, sometimes they're going to be a little more vague on those things. Effectively, just like a mutual fund, what you're actually buying here is their knowledge and their expertise and what they're attempting to do in the market, right? They're trying to outperform usually in those cases. And effectively what you're betting on is the performance of the manager of the fund being better than the index itself. Whether or not that's actually a good idea or not, completely different question, but hopefully that's starting to answer some of these questions. But I just wanted to hit that really briefly because I saw a couple questions on, how do we evaluate which one's better or worse? If you're getting two things that are the same, first of all, you have to make sure that the objectives are going to be the same. I'm not 100% momentum score of the S&P small cap 600. So if you wanted to know exactly what that looks like, you got to go to the prospectus. And I don't even want to try to summarize it for everybody because I don't want to mischaracterize or misstate what they're attempting to do. I get the general idea, but I don't want to misspeak and tell anybody the wrong thing. All right. Let's see. Maybe I know Troy, you got to wrap up. If you got to get out of here because Troy's in another session after this, feel free. I'm gonna stay and just maybe answer a handful more of these questions that came through. There's only about 3 more, so I'll stick around. But Troy, yeah, go ahead and hop because I know you gotta run here. Robert was asking, is there a place where I can do a lookup on the stock index currently symbol to use for charting? So there's not a glossary or an index. You're asking about the Nikkei. I can just tell you what it is. So if you type in period N 225, that'll give you the Nikkei 225, and it'll give you the value over here, and then it'll tell you the points that it's up or down. And we don't have research for indices, but you can still chart it if you wanted to. So if you're trying to chart the Nikkei, it's yeah, that's a market crash right there, folks. 42,000 to a low of 31 in a very short word. Key is the Russell 2000. There's a kind of remember them is the reality of that situation. If you ever have a question on it, though, you can usually call, and they probably won't know whoever answers the phone, but they can reach out to one of us, or usually there's somebody around that will know. So if you ever have the question on that, just call us real fast, and we should be able to get you an answer pretty quickly. Wanted to talk about the analysis feature, ST. So let's go to this really fast here, because there's the sentiment. So we have all of these for the fundamental and the technical side. So this one's provided by the third-party Trading Central. This is provided by S&P Global Market Intelligence. Basically, it's just the 2 different buckets of major analysis. Technically, there's a third. There's the quantitative bucket, which requires pretty intensive mathematical knowledge and study in order to effectively do. But the fundamental side is just looking at things like valuation. Was asked a question: how do we know if something's overvalued or undervalued? Well, this page right here will summarize what S&P Global Market Intelligence is thinking about those things. So if you click on this, it'll give you just a quick of how they're coming to this conclusion. I'll give you a little bit more in financial statements to do that. Earnings quality has been good for this one, even though it's on the higher end of valuation. Growth stability right in the middle, and then financial health, again, using things like the balance sheet to determine the company's debt and interest obligations, and comparing that to similar things in the industrial sector. That's the key. Whereas if we're looking at the technical things, this is basically just looking at, they have a proprietary system that they use where they're looking at all sorts of different things, pivot points and Fibonacci's and trend and momentum, and they don't explain how they do it, because again, why would you need them if they explained everything that they did? But they break this down into 3 different buckets here. The short term, they define the length, and then they're saying whether the technical picture is looking weak, strong, or neutral. And that's another way to analyze that. Also in statistics here, because we were asked about the statistics for how do we know if something is overvalued or undervalued, or what's their growth. On the key statistics, it also tells you what percentile they're in for the market cap and the PE. So that's another way. It'll tell you that right there for all of these different things. And, if you click on more, I showed this briefly yesterday, but it just gives you a little bit more description for each of those buckets. So, when we're looking at this picture, right? Annual or long-term debt to equity, pretty high compared to the average, 95th percentile. So if you're looking on the fundamental side of things and you're looking for a comparison, the bottom up approach, which is, hey, I'm looking for individual stocks in the sector or industry. What is the picture compared to other stocks in the same industry or sector? This would be a way to do it. So, Randy, hopefully that answered your question about the analysis feature. I'm hoping that's what you meant. All right. Michael, I appreciate that link. I'm sure that's probably correct. That the only thing is, once we get outside of those main three, I think that's where our symbols start to diverge. Like, we have the Hang Seng, Korea, Bovespa, a lot of the European indices like the FTSE, the DAX. Some of them are the same, some of them are not. So I'm hesitant to tell any other ones. So if you had one specific I could answer, maybe has the same ones. They session here. All right, I think that pretty much wraps us up. I didn't really see any other questions. I will just say one other thing here. When we're thinking about research, it's always very important to think about the perspective of what am I trying to accomplish first? What am I trying to have in terms of allocation? Maybe actually that's a great way to wrap us up, because I didn't talk about it yesterday. I wanted to talk about it in the follow-up, but we had so many great questions. I got sidetracked here. The analysis tool is going to be your best friend when you're thinking about your allocations. When you're considering, when you just go to more and then analysis on that main portfolio page, when you're considering what you're trying to accomplish in the business cycle or the industry, one of the things I stressed yesterday is just because something is historically done well, it doesn't have a hit rate of 100%. Meaning, if we go through the last 10 business cycles, maybe financials has outperformed in the early phase 9 out of 10 times. Guess what? Maybe it didn't in that one time. Maybe it did really poorly. And I'm just using that as a random example. I don't actually have any actual stats behind that one, but there are some, and that's what Denise tries to display in her reports. The problem with doing that is, what if you're picking the one time where your sector is not going to be outperforming and you sold everything else, and maybe you're even like leveraged or fully concentrated in that? That can set you back for years. It can set you back for life. So you have to be really careful. And that's why Nick was doing talk. Here's the three best sectors for recession phase. Sell everything, go 33% in each of them. That's not what we mean. But this analysis tool helps you understand, basically at the very top level, what allocations do I want to stock, bonds, and cash. Those are our three buckets. And it breaks domestic and foreign stock up. But these are our three buckets effectively. And then further, we can break this down into style and sector. So do I want to be in large caps? Do I think that small and mid are getting a bounce? This will tell us how we're invested on the left-hand side into the large, medium, small. And then do I want value stocks? Do I want growth? Do I want a blend of both? And then over here, it's not saying that this is the best way to do it. It's just telling you what the US market looks like as a whole. So we're just comparing the US market to what we have, and you can adjust accordingly. And it'll tell you specifically, if we go underneath small, medium, large, value, blend, growth, it tells you what my company is. So let's say you didn't know that Bank of America was a large company, and let's say you didn't know it was a value company. Well, now you know. And then this is really helpful for our mutual funds and our ETFs, where it's maybe less clear with all the holdings what they have. Well, our tool will break that down for us. So Magellan is in medium growth, and then large blend, large growth are the main things that it's looking at. Contra Fund has a much wider array of different things. It pretty much has everything except for small cap value. So we can break that down that way, and then we can do the same thing with sectors. Similar thing here. The white line is where the US total market is percentage wise in terms of sector. So for us, this is just a little test account so we can demo things like this. Our account's 68% in financials. The index should be 13%. So we're way overweight is what this is telling us in financials, which, we don't do this with any kind of discretion, right? It's just mainly to have something to show. But if you're underweight, you'll see your blue bars underneath the white line. And basically, same idea here. We can scroll down and say, okay, well, let's say I didn't know that Bank of America was financials. Well, it tells me right there. Or Take Two. Maybe you've never even heard of that company. Well, we know Take Two is in communication services now. And then it does the same thing for our ETFs or our mutual funds. So the idea is to take this research, craft out from a macro level, what kind of allocations am I looking for? Next step is to, okay, do I want to be more tactical and say, I want to overweight, underweight certain sectors, certain classes of value or growth or market capitalizations? And then you come to this tool and you see where your account currently sits. And well, if I add new applications and this tool can help. So seeing a question, what research report Argus addresses what? I have no idea what that question. Argus is just one of the independent research providers that we use. So if you go to any of these stocks that are in the top 1,500 usually in terms of market cap, if you go to analyst ratings, and it's taking a minute here. So here's Argus. It's just a report. So you click on the date, pull the report, and it'll look something like this, right? So you have basically a lot of the same numbers that we're looking at on the various pages. It just kind of summarizes it for you. What's nice about the Argus ones is it gives you a target price, right? So they're saying 242 on this, current price is 220. And then they give you some reasons why. So, it does this A6 subcomponent score. So it breaks down the fundamental picture into these 6 different categories and rates it high, medium, low. Talks about the institutional holdings. And then it comes down here and it will give you some comparisons based on the peer. So looking at the growth rate for EPS, looking at the current fiscal year price to earnings ratio, net margins, 1-year EPS growth rate, and then whether Argus rates it as a buy or hold. So that's what the Argus report is there in a nutshell. All right. All right. Yeah, I think that's it. Don't see any more questions coming through there. Appreciate everybody for coming to the webinar yesterday or the follow-up today if you didn't make it to the one yesterday. Hopefully you found some nuggets of information here, found this useful. And just to let everybody know, maybe this is the first coaching session that you've been in. Yesterday was a webinar. My team, the strategy desk, we do these coaching sessions. We do 6 of these a day. They're not all on fundamentals. A lot of our stuff is based on options, technical analysis, which is looking at the charts, charting patterns, market briefings, things of that nature, tool demos. We definitely do a fair share of that, but with definitely encourage .com/coaching. That'll take you